Feeling that knot in your stomach? Watching the market swing wildly? Hearing talk of tariffs, recessions, and maybe even seeing your own portfolio take a hit? It feels like the financial sky is falling for many right now. The urge to sell, to run for cover, is almost overwhelming. But what if I told you that this very fear, this palpable uncertainty, is precisely when the smartest long-term investors lean in, not out? Welcome to the Infinite Income Channel. Forget the panic, the uncertainty, the fear. In this video, we're going to talk about why now might be one of the best times to focus on the bedrock of long-term wealth: resilient, dividend-paying powerhouses. Stick around as I reveal 3 never-sell gems I believe are poised to turn today's anxiety into tomorrow's reliable income stream. The early months of 2025 witnessed a dramatic and rapid reversal in stock market sentiment. An initial uptrend gave way to significant declines, briefly pushing the market down over 20%. This abrupt shift was fueled by renewed concerns over international tariffs and mounting fears of a potential global recession, echoing disturbances seen in leading economic indicators. Key metrics are flashing warning signs. For instance, Goldman Sachs's Business Optimism Tracker, a composite index drawing from numerous leading U.S. indicators, has reversed its year-long climb, suggesting heightened caution among businesses. This pessimism is further corroborated by the Bank of America Fund Manager Survey, which revealed a sharp spike in predictions for an economic hard landing, following specific political announcements, reaching levels unseen in at least 2 years. Compounding these anxieties is a challenging macroeconomic backdrop. The United States faces the complex task of refinancing substantial short-term debt amidst an elevated budget deficit and also persistent inflation risks, potentially exacerbated by tariffs. This environment makes attracting buyers for longer-term government bonds difficult, hindering efforts to lower long-term interest rates. Consequently, investors have increasingly sought refuge in tangible assets like gold, causing the S&P 500 to gold ratio to fall to lows reminiscent of the 2020 pandemic crisis. While this confluence of negative factors paints a concerning picture, a degree of skepticism is warranted. Economic forecasting is particularly challenging currently, as significant policy decisions, especially regarding trade and tariffs, like a potential agreement with China, could drastically alter the outlook almost overnight. The market feels highly sensitive, potentially just one tweet away from a major rally or slump. Crucially, history teaches that periods of intense market fear often precede significant buying opportunities. Current global fund manager sentiment, nearing the extreme lows seen during the COVID-19 pandemic, appears disproportionately negative. Despite stated intentions by many fund managers to reduce exposure to U.S. equities, the actual follow-through remains uncertain, particularly given the U.S. market's recent underperformance relative to global counterparts. While acknowledging the real risks, including the potential for an escalating trade war to trigger a recession, the prevailing strategy remains grounded in historical success, acquiring high-quality companies during periods of uncertainty. This approach focuses on long-term value creation. With that philosophy in mind, let's revisit 3 compelling dividend-growing stocks, often overlooked, that possess the resilience, pricing power, and strategic positioning to potentially outperform the market significantly in the coming years. First up is Deere & Company. Deere has meticulously built a dominant global presence over decades, particularly in agriculture, large tractors, combines via production and precision ag, and construction. While penetration varies geographically, smaller tractors are more popular in India, Deere is a leader in the lucrative North American, South American, and European markets. It operates within a massive $150 billion addressable market, continuously innovating through automation, AI, and other efficiency-enhancing tools for farmers. This leadership in next-gen farming underpins its strong brand reputation and significant pricing power, allowing it to command premium prices. Despite the modest yield, Deere's dividend history is impressive. The payout has more than doubled since 2020, including a recent 10.2% hike in December 2024. The company maintains a conservative payout ratio, around 27% of earnings, providing ample room for future growth. Furthermore, Deere actively returns capital via aggressive share buybacks, having repurchased nearly 20% of its outstanding shares over the past decade. Importantly, Deere has a history of maintaining its dividend during challenging economic periods, demonstrating financial resilience. The company is currently navigating industry headwinds. High interest rates, macroeconomic uncertainty, and surplus used equipment inventory are expected to cause a roughly 30% decline in large agricultural equipment sales in the U.S. and Canada this year. Tariff concerns add another layer of uncertainty. Though Deere's direct exposure appears manageable with only 5% of sales from Mexico and 2% of U.S. manufacturing costs tied to Chinese goods. Despite downward revisions in near-term analyst earnings forecasts, 2027 EPS estimates were adjusted from $31 down to $25. However, the long-term potential remains attractive. If a severe recession is avoided, factors like persistent inflation, bolstering pricing power, tight global agricultural commodity supplies, and the eventual need for equipment replacement could drive earnings back towards the $31 mark. Applying a historical average multiple of around 20 times price to earnings, to such earnings potential supports a long-term price target near $600. Currently trading around 20 times blended price to earnings, Deere historically outperforms the S&P 500 over the long term, albeit with temporary underperformance during economic downturns. Second on our list is extra space storage. Finding companies with durable competitive advantages, or moats, is crucial for long-term investing. While real estate investment trusts often struggle to establish strong moats beyond access to capital, extra space storage stands out within the self-storage subsector. Although building storage facilities is relatively easy, limiting traditional moats, the self-storage industry itself offers compelling characteristics. Demand tends to be steady, driven by life events, moving or downsizing, consumer accumulation, and business needs, proving somewhat resilient across economic cycles, though sensitive to housing market shifts. Operational advantages include low maintenance costs compared to residential or commercial properties and potentially high profit margins due to scalable operations. Furthermore, self-storage facilities are increasingly relevant for micro-storage and last-mile logistics supporting e-commerce, given their typical proximity to population centers. A key advantage is rapid rent adjustments, allowing quicker responses to inflation and market demand compared to long-lease properties. EXR has leveraged these industry dynamics effectively. Its historical performance is exceptional, the highest 20-year total return among self-storage real estate investment trusts and the third best among all public real estate investment trusts. EXR consistently demonstrates superior operational execution, often beating peers in same-store revenue growth. EXR currently offers an attractive dividend yield of 4.7%. Similar to Deere, EXR prioritizes dividend stability during challenging times. The dividend has been held steady since 2023 amidst housing market weakness, followed by aggressive growth during favorable periods. Over the past 10 years, the dividend has more than doubled, showcasing its commitment to returning value to shareholders. Due to recent sluggish growth tied to the housing market slowdown, EXR trades at approximately 18.3 times its adjusted funds from operations, below its long-term average multiple of 20.3 times. Analysts anticipate a return to growth, projecting AFFO per share increases of 1% in 2025, 5% in 2026, and 4% in 2027. This trajectory suggests potential annual returns of 11 to 12%, combining the dividend yield and modest growth. While a rebound in consumer confidence and home sales would likely accelerate performance, the current valuation presents an attractive risk/reward profile for long-term investors. And third on our list is Caterpillar, an industrial giant poised for a rebound. Despite recent stock weakness, Caterpillar's focus on expanding its services business and its strong ties to commodity markets make it a compelling investment. Instead of investing directly in volatile mining stocks, Caterpillar offers a strategic picks and shovels approach. It supplies essential equipment to industries like mining and construction, often benefiting from stronger pricing power and less direct operational risk than its customers. Historically, Caterpillar's stock price has correlated closely with key commodity prices like copper and gold. However, A significant divergence has recently emerged, with CAT stock selling off sharply, down nearly 30% from recent highs, due to tariff concerns and related recession fears, while underlying commodity prices remained relatively firm. This disconnect presents a compelling opportunity. If the economy avoids recession, CAT appears significantly undervalued. Even if a recession materializes, much of the potential downside may already be priced in, improving the risk-reward balance. Caterpillar continues to strengthen its business model, focusing on its rapidly growing services segment. Service revenues reached a record $24 billion last year, now accounting for 37% of total sales. This shift towards services, supported by digital tools like the VisionLink telematics platform and AI-driven service recommendations, enhances customer loyalty and creates more predictable, recurring revenue streams. Over two-thirds of new equipment sales now include customer value agreements, locking in future service business. Caterpillar boasts an installed base of 1.5 million connected assets, providing invaluable data and service opportunities. This focus on services contributed to adjusted EPS growth, plus 3% last year, even as total sales dipped slightly. Caterpillar has an outstanding track record of rewarding shareholders. The stock has significantly outperformed the S&P 500 over the past decade, showing a 341% total return, aided by substantial share buybacks, reducing share count by over 20%. The company is a dividend aristocrat with over 30 consecutive years of dividend increases, currently yielding 2.0% with a very safe payout ratio of just 25%. In the last year alone, Caterpillar returned over $10 billion to shareholders, primarily through nearly $8 billion in buybacks. Caterpillar currently trades at a compelling valuation of just 13.6 times earnings, notably below its long-term average multiple. While analysts expect a temporary EPS decline this year due to economic uncertainty, they project a return to robust growth of 10 to 11% annually through at least 2027. Given its operational strengths, shareholder focus, attractive valuation, and potential tailwind from any rotation towards value stocks, Caterpillar appears well-positioned to beat the market going forward. The market's sharp downturn in early 2025, driven by a potent mix of tariff threats, recession anxieties, and geopolitical instability, has understandably unsettled investors. Leading indicators reflect deep pessimism, potentially suggesting a severe downturn ahead. However, extreme negative sentiment can be misleading and often creates valuable entry points rather than signaling impending disaster. While the economic challenges are real, the current level of fear seems excessive. Therefore, the core investment strategy remains unchanged. Focus on acquiring stakes in high-quality, resilient businesses during periods of market stress. Deere & Company, Extra Space Storage, and Caterpillar exemplify this approach. These companies possess strong market positions, proven resilience, commitment to growing dividends, and returning capital via buybacks and attractive long-term growth prospects. Despite the prevailing uncertainty, focusing on such high-caliber stocks offers a sound path toward achieving long-term financial goals and potentially generating market-beating returns, thanks to their resilience, strong fundamentals, and ability to capitalize on opportunities in evolving market conditions. All right now, it's time for one of my favorite segments, the Dividend Doctor's Portfolio Checkup. Today's question comes from Tom in Georgia. He writes, I've been following your advice and holding on to solid dividend stocks, but with all this recession talk, I'm tempted to sell and move to cash. Am I crazy to hold on? Tom, you are absolutely not crazy for feeling that way. Fear is natural. Everyone feels afraid from time to time. But selling high-quality dividend stocks during a panic often locks in losses and forfeits the powerful recoveries that follow. We invest in businesses, not just stocks. Those industrial names you hold have weathered storms far worse. Staying invested through tough times is how long-term wealth is built. Think of it like staying on a sturdy ship during rough seas. It might be uncomfortable, but jumping overboard guarantees you'll miss the destination. The only way to achieve greatness in life is to have patience, consistency, and discipline. Thanks again for the great question, Tom. Now, before we wrap up, a quick reminder. I am not a certified financial advisor. The information shared here is for informational and entertainment purposes only. Investing always involves risk, including potential loss of principal. Always consult a qualified advisor who understands your unique situation. So there you have it, folks. Another dose of dividend wisdom on the Infinite Income channel. While the markets churn and headlines scream, remember, enduring value often hides beneath fear. Focus on business quality, stay disciplined, and let compounding dividends do their magic. Don't let short-term noise derail your long-term financial freedom. This is George Mayfield, the Dividend Doctor. Until next time, stay invested and keep building that infinite income.